We're looking at the Nifty 500 as well. Oracle Soft is down. Rail Vikas Nigam under pressure at about 130 after a terrific run-up in the last 6 months or so. Sundaram Fasteners, Spandana and even an HSCL is down about 2% in trade. But happiest minds then, that's in the spotlight in today's trade. Let's connect with the management to talk about decoding their quarterly performance. We've got Joseph, who is the Executive Vice Chairman, as well as Venkatraman Narayanan, who is the MD and CFO. Thank you so much, gentlemen, for taking time out. I'm going to start off with you then, Joseph. You mentioned that in the press release that the earnings have been impacted on account of the, a bit of a right shifting in revenue. Can you just walk us through what that means? What is the outlook then when it comes to Q1?
As we mentioned in our earnings call yesterday, what we observed, unlike typically budgets getting decided by November, latest by December, this year we saw that whole process getting pushed out into January and in some cases first half of February as well. And as a result, many of the opportunities that were under discussion and which we expected to start early January, they got pushed out into Feb and in some cases into March as well. And that's what we meant by right shifting of revenues. Again, we've given a guidance of 25% for FY25 and FY24, and that is based on some of these opportunities that got closed in March. And we expect Q1 to be to reflect this right shifting of revenue as well.
So staying with you, Joseph, are you talking then about some sizable deal delays, cancellations or ramp downs?
So, we didn't have any major ramp downs as such, but what happened is the opportunities that we thought would be starting in January, those got delayed. And, some of them started as late as March and as we speak, a couple of these opportunities got closed in the first half of April. But the encouraging fact is that many of these opportunities are large in size, and therefore and they are over a longer period of time, which is giving us the confidence to give the guidance of 25%. But I just want to stress again that we've not seen any major ramp downs as such. You have projects that get completed or programs that that reach a logical conclusion, and then there's always that gap between the completion of a program and customer deciding what they want to do next. Once they take it to market, get customer feedback. So that's a normal rhythm, and we've had a couple of those, but we've not really experienced any major ramp downs as such.
Right. Venkat, you managed to beat the FY23 margin guidance of 22 to 24%. What number should we pencil in for FY24?
To start with, we are continuing with our margin guidance of 22 to 24%, while hoping and working to beat that, just like what we have done in the last 12 quarters. So last 12 quarters, we have had margins in excess of 25%. And this year, we ended the year with about 26.2% growth. If you look at the margin growth itself, EBITDA, year over year has grown about 29%. So it shows that while we are holding on to margins, we are also expanding on the same in line with business growth. Just a metric on the year-over-year growth with respect to revenues, because you did ask Joseph about the revenue growth. Just in Q4, we grew 18% year-over-year in terms of revenues in constant currency. So that number is still solid, just that we got affected by that 4 or 5% because of the right shift that we just talked about. And for the year, we have touched about 24%, 1% below guidance, while handsomely beating our margin guidance of 22 to 24%. So in effect, the performance has been good, and we are looking towards a great Q1, good Q1, excellent results to build the next year on.
Right. Joseph, client mining and acquisition has been a focus area. Tell us a little bit about how key metrics have trended over the last few months for you.
If you see both the metrics that you mentioned, from our fact sheet, you'll see that both have seen an increase. The average revenue per customer has been consistently increasing over the last 3 years. And again, this year you see a similar trend. We've crossed the 800 mark now. We're at around $806,000 or so per customer. And this will continue to be a focus area for us to see how we can push this number further up. And in terms of, again, $1 million customers and larger customers, we had, as of last year, right, we ended last year with $31 million customers, and we added 9 of those in the current year. We are currently having $40 million customers. And again, there's been an increase in the $5 to $10 million customer as well, $3 to $5 million customer as well. You talked about new logos, and the encouraging sign, which again gives us the confidence to give the guidance and to be positive on Q1, to expect a good Q1, is the number of logos that we had that closed in Q4. We had 16 new logos being added in Q4, which is among the highest that we've had, and many of them closed again in the March timeframe. So all in all, pipeline's looking good, and we've had some good closures both within existing customers and new logos.
So, Joseph, are you on track to reach the $1 billion target earlier than 2031? And what role do you think acquisitions would play in this?
So, we are very confident that we'll be able to reach that number of $1 billion by 2031, hopefully, as you said earlier. And I think the inorganic acquisition will be critical to getting to this goal from 2 angles. One is just to give a little bit of that revenue cushion, but more importantly, I think it will give us some of these engines of growth, whether it's depth in some verticals. If you see the SM acquisition that we did, it's given us deeper capabilities in 2 areas. One is in the healthcare space, and the other one is on the supply chain side, which we are beginning to leverage with other customers and to build offerings around. So we'd like to have similar such acquisitions, which will give us depth in a few vertical or solution areas and in a couple of technologies. And I think from both these angles, it's critical for us to get an acquisition done. We should have done something a little sizable, but as we've said earlier, we want to be prudent and make sure that we get the right kind of company and at the right valuation.
All right. Thank you, gentlemen, for joining in and giving us a sense as to how business is shaping up. So that's the view. Q1 is going to be better. They hope to achieve that $1 billion run rate before 2031 and will maintain guidance for FY24 at 22 to 24%. That's happiest minds for you at about 863. Well, moving off.